Have you ever wondered how those incredibly generous donations by the super wealthy actually factor into their financial strategies? It is not always as simple as writing a large check and instantly getting a matching tax break. There are some clever rules in play, designed to ensure fairness in the system, even for those with vast fortunes. Adjusted gross income, or AGI, limitations absolutely affect wealthy tax planning, especially when it comes to charitable contributions. These rules mean that even the richest philanthropists cannot deduct an unlimited amount of their charitable giving in a single tax year, regardless of how large their donation might be. It is a key factor they must consider in their financial decisions. The core reason behind these limitations is to maintain a balance within the tax system. Your AGI is essentially your gross income minus certain specific deductions, like contributions to traditional individual retirement accounts or student loan interest. The Internal Revenue Service, or IRS, then applies percentage limits to how much of your AGI you can deduct for charitable gifts. For instance, cash contributions to public charities are typically limited to 60% of your AGI, while gifts of appreciated assets like stocks are generally capped at 30%. These caps prevent anyone, no matter their wealth, from entirely eliminating their taxable soles through donations, ensuring everyone contributes a baseline amount to government services. So, how do the wealthy navigate these caps? One common strategy involves spreading out large donations over several years. Since you can carry forward unused charitable deductions for up to 5 years, a very substantial gift can provide tax benefits for half a decade. Another popular tool is the donor-advised fund. With a donor-advised fund, or DAF, a wealthy individual can contribute a large sum to the fund in 1 year, taking an immediate tax deduction, and then recommend grants from that fund to various charities over time, aligning with their philanthropic goals without being constrained by annual AGI limits on their actual giving timeline. Another sophisticated move involves strategically mixing different types of contributions. Donating appreciated securities, such as long-term held stocks, can be highly tax efficient. Not only do these gifts count towards the charitable deduction, but the donor also avoids paying capital gains tax on the appreciation of those assets. This is a significant double benefit for the wealthy. They also often establish private foundations, which offer greater control and a perpetual vehicle for their giving, although these foundations come with their own set of AGI limitations for deductions, typically lower than for public charities. Ultimately, these AGI limitations encourage thoughtful, multi-year charitable planning rather than spur-of-the-moment large write-offs. For the wealthy, it means working closely with their financial advisors to optimize their giving strategies, ensuring their generosity achieves both maximum social impact and their intended tax benefits, rather than simply writing off their entire income.